You are listening to The Vocal Technologist. Spoken tech for your ears.
So imagine logging into your company portal, right? You go to check your performance review, and you suddenly realize the entity approving your annual leave, managing your department budget, and authorizing your salary is not a human being.
Which is a terrifying thought.
Oh, absolutely. It is literally an autonomous piece of code, just a digital script functioning as the actual executive of the company you work for.
Yeah, it sounds completely absurd.
I mean, it sounds like the plot of a science fiction movie that usually ends really poorly for humanity, but that is exactly the reality we're starting to see unfold right in front of us. I am your host, and you are tuned in to Vocal Technologist.
Where we try to make sense of all this madness.
Exactly. We take these incredibly complex technological developments and translate them into plain English for smart professionals who are, time poor but fiercely curious. And joining me to help figure this all out is our resident expert.
It is great to be here. And honestly, the sheer scale of what we are going to look under the hood of is staggering.
Yeah. We are going to unpack a massive stack of material covering the absolute collision of artificial intelligence, traditional finance, and blockchain technology. Yeah. Our mission is to pull all of this apart and figure out what it actually means for you.
Because we are witnessing a fundamental rewiring of how economic value is created. I mean, for the entirety of human history, we have viewed technology as just a tool, right? A hammer, a calculator, a computer.
Right.
But we are crossing this threshold where the tools are becoming economic actors in their own right.
Okay, let's unpack this whole AI boss situation first, because I reckon a lot of people listening are probably picturing like a polite chatbot asking them for quarterly deliverables.
Yeah. That is the common misconception.
But we are seeing the evolution of AI from a simple large language model to a fully autonomous financial entity. A perfect example we found in the material is the AI trading arena that Coinbase launched.
Right. The Coinbase arena is fascinating.
Anyone can just build a trading strategy using natural language, set a few parameters, and let an AI agent loose to trade on their behalf in a segregated portfolio. The really wild part to me is that you can actually view the reasoning behind the AI decisions on a public leaderboard.
Yes, and understanding that mechanism is crucial. The AI is not just randomly guessing or, throwing darts at a board.
Right, it has actual logic.
Exactly. It is analyzing market sentiment, reading complex white papers, and executing trades based on logical pathways you can audit. But if we take that technical capability and apply it to a broader economic theory, we run into a really fascinating thesis put forward by Sriram Kannan.
Oh yeah, this part blew my mind.
He argues that AI agents are not just going to be traders, they are literally going to become autonomous companies.
Right, but hang on. How does a piece of software actually become a company? I mean, I cannot just declare my laptop as a limited liability corporation.
Well, the binding constraint on an AI company right now is not its intelligence, right? It is not its ability to provide a service. The main constraint is legal rights.
Because you need a human.
Precisely. Traditionally, to do business, you need a human legal proxy. You need a person with a passport and a physical address to walk into a bank, open an account, sign a vendor contract. The legal system absolutely requires a human anchor.
But Cannon points out that blockchain smart contracts completely bypass this requirement, do they not?
They do, because smart contracts can own and administer assets directly on a cryptographic ledger. You can actually couple AI cognition to a contractual layer.
So the AI can hold digital property, buy domain names, and access global capital pools without ever needing a human to sign a single piece of paperwork.
Exactly.
That makes sense in theory, but for an AI to actually operate a business, it needs to be able to buy and sell things out in the real world. And the material points out that early attempts at AI commerce completely fell flat on their face.
Yeah, they were a disaster.
Like that example of Walmart trying to integrate ChatGPT, and they saw this massive drop in conversion. To me, the current state of AI commerce is, well, it is like forcing a robot to wait in line at a physical supermarket checkout.
Making it fish around for coins.
Exactly. Making it fumble with the leather wallet instead of just letting it plug a cable straight into the cash register. I mean, bots do not need visual interfaces with shiny add to cart buttons.
That is exactly the friction point. Human interfaces are built entirely for human psychology. They are slow, they are visual, and they require manual confirmation. An AI agent operates in milliseconds.
So what does it actually need?
It needs invisible payment rails. It needs HTTP native protocols.
Hold on, let's translate that for a second. When you say HTTP native protocols, what does that look like in actual practice?
Well, think about how you browse the internet. If you go to a dead web page, your browser gets a 404 error code, right?
Yeah, it happens all the time.
That is an HTTP status code talking directly between two machines. What the industry is building right now are essentially HTTP status codes for money.
Okay, well,
For example, there is a protocol called BY402 being tested on the base network. When an AI agent wants to access data or buy a digital service from another AI, it just sends a request.
and then the server responds with a code.
Yes, a code that essentially says, I require a payment of 0.001 cents to proceed. The AI wallet instantly signs the transaction, the blockchain settles it, and the data is delivered.
Just like that.
A single request and response cycle handles the entire transaction in fractions of a cent with absolutely zero human input.
Okay, that is brilliantly efficient. But I have to push back here, mate. Because if we have an AI agent operating as an autonomous company, buying and selling things on these invisible rails at lightning speed, what happens when things go pear-shaped?
That is the big question.
Right. Because if an AI company goes bankrupt or leaves creditors out of pocket, or worse, does something highly illegal, who exactly goes to jail? You cannot put a line of code in handcuffs.
And that is the exact paradox legal scholars are wrestling with right now. Cannon highlights that the true hurdle here is legal continuity and liability.
Because it is just software.
Right. How do you ensure the agent persists as an enduring firm rather than just a temporary software process that someone can delete to avoid consequences? If an AI has no human proxy, the traditional legal system has absolutely no one to punish.
So if an autonomous AI trading firm causes a massive flash crash, who is liable?
Is it the person who wrote the original code? Is the blockchain network hosting the smart contract? Is it the AI itself? We are going to need entirely new frameworks for software-native capital structures because our current legal systems are based entirely on human accountability.
Which brings us perfectly to the reality of the technology we're actually building, because this legal gray area highlights a much broader issue in the crypto space. We are building these massive autonomous financial systems, but we still have not solved the most basic security vulnerabilities.
No, we definitely have not.
Let's pivot and look at the Drift protocol breach, because this completely blew my mind. It was not some super sophisticated brute force hacking of a mainframe.
It was an incredibly elaborate long con.
Elaborate is an understatement. A state-affiliated group from North Korea, called UNC 473D6, spent 6 entire months socially engineering the Drift team. They posed as a legitimate quantitative trading firm.
And they put their money where their mouth was.
Yeah, they actually deposited over $1 million of real money into the protocol just to build trust with the developers. They went to industry conferences, they built face-to-face relationships over drinks, before finally tricking the protocol contributors into downloading a malicious code editor extension.
It is staggering.
It is wild to me. Hackers are out there doing more in-person networking and relationship building than actual venture capitalists.
I mean, it sounds like a spy thriller, but the mechanics of the attack are what make it so dangerous. They did not attack the blockchain itself. They attacked the human workflow.
Right, the weakest link.
Exactly. By getting developers to install a compromised code editor extension, the hackers gained access to the developer's environment variables. That means they could quietly siphon off the private cryptographic keys used to manage the protocol funds.
So while developers are obsessing over complex mathematical vulnerabilities, the most expensive breaches occur just through basic human deception.
Precisely.
But speaking of those complex mathematical vulnerabilities, we cannot ignore what is coming down the pipeline. The material brings up the looming threat of quantum computing.
Which is a very real, very mathematical threat.
Yeah, we have research from Google and Caltech suggesting that quantum machines could break Bitcoin elliptic curve cryptography in just 9 minutes. 9 minutes. That is enough to make anyone holding digital assets sweat a bit.
Absolutely.
What exactly is elliptic curve cryptography, and why does a quantum computer smash through it so easily?
So in simple terms, elliptic curve cryptography is the mathematical lock that secures almost all digital assets right now, including Bitcoin. It relies on the fact that classical computers take an impractically long time, we're talking millions of years, to factor massive prime numbers or solve specific algorithmic puzzles.
Okay, so it is just too much math for a normal computer.
Right. But quantum computers do not process information linearly like our current computers do. Using something called Shor algorithm, a sufficiently powerful quantum computer can calculate all possible combinations almost simultaneously.
Wow.
What takes a supercomputer a million years takes a quantum computer a few minutes.
So it is essentially a master key that just ignores the lock entirely. And the industry seems completely split on how to handle this reality.
It is very divided.
On one side, you have Circle rolling out a comprehensive post-quantum security roadmap for its ARC-L1 blockchain, deliberately building validator-level protections right now.
Yeah.
And you have the Neoris protocol, which just launched a network with post-quantum cryptography built into the foundation from day one.
They're taking it very seriously.
But conversely, you have Michael Saylor, who is obviously one of the loudest voices in the space, just dismissing the entire quantum threat as theoretical and decades away. He argues the Bitcoin network can simply upgrade its open source code before any attack actually happens. Is Saylor being dangerously complacent here?
It is a fascinating philosophical divide. Saylor is relying on the assumption that a decentralized network consensus will act rationally and swiftly in the face of an existential mathematical threat.
He trusts the community to fix it.
Right, he trusts the protocol ability to adapt. But looking at how slow governance decisions can actually be in open source networks, upgrading the core cryptography of a trillion-dollar asset is not like, downloading a software patch on your phone.
Definitely not.
It requires massive coordination. And frankly, relying on a future fix for a known impending threat is a massive gamble.
Especially when we just established that a charming bloke at a conference can convince an engineer to hand over the keys anyway. You can build a post-quantum fortress, but if the guard gets duped, the cryptography does not matter at all.
That is a very fair point.
But here's what really stands out to me. Despite these massive existential security risks, and despite the wild frontier of AI agents running around doing autonomous business, traditional Wall Street institutions are aggressively building infrastructure to swallow this entire market whole.
The institutional pivot is undeniably the biggest structural shift happening in finance right now.
It really is. I mean, my bank hits me with a ridiculous fee just for looking at my savings account the wrong way, but observe how quickly Wall Street changes its tune when there are massive new institutional fees to be made.
The profit motive is a powerful thing.
Morgan Stanley just launched MSBT, which is the first spot Bitcoin ETF issued directly by a major U.S. bank. And they are playing serious hardball.
Oh, absolutely.
They are undercutting BlackRock with a 0.14% management fee. They are handling the actual custody of the assets via Coinbase. And analysts project they will hit $5 billion in assets under management in their first year alone.
And Charles Schwab is also getting in on the action, opening a wait list for direct spot buying of Bitcoin and Ethereum for its massive retail client base.
Which is huge.
It is. But what is driving this adoption is not just the pursuit of fees, though obviously that is a massive factor. It is also being emboldened by a shifting regulatory perspective. Yep. For years, the traditional banking industry lobbied really hard against digital assets, specifically stablecoins. They argued that if people put their dollars into stablecoins, it would drain deposits from traditional banks, causing a systemic risk to the lending economy.
But the White House Council of Economic Advisors just released a comprehensive study that completely dismantled that argument, did they not?
Yes, and the numbers in that study are quite staggering. They found that even if the government completely banned the yield generated by stablecoins, it would boost traditional bank lending by a microscopic 0.02%.
Wow. So it basically proved the banks were crying wolf about a systemic threat that just did not exist.
Precisely. And once that systemic risk argument is removed, institutions are totally free to adopt the technology for its underlying utility. Sid Gandhi puts forward an excellent framework for this.
What does he argue?
He says that we need to stop thinking about stablecoins purely as money. They are the token plus the rails. The underlying speed, the security, and the transaction fees of the blockchain actually become the physical properties of the money itself.
I love that. I always like to think of it like different types of cargo trains.
Okay, how so?
Well, the cargo inside the train, which is the actual US dollar value, is exactly the same, whether it is sitting on an old clunky banking ledger or a modern blockchain. But the tracks determine how fast and cheap the journey is.
Right.
A cargo train on a high-speed magnetic rail network operates completely differently from a train rattling down an old, broken dirt track. The money is exactly the same, but the physics of how it moves change entirely.
That is a very helpful way to visualize it. But those high-speed tracks introduce entirely new risks, which is exactly what global regulators are panicking about right now.
Of course they are.
The International Monetary Fund, the IMF, recently issued a stark warning about this exact dynamic. They pointed out that as traditional finance moves onto these blockchain tracks, tokenized finance could severely amplify market crises.
Wait, how so? If it is just a faster track, why does it make a crisis worse?
Because of the automation. In traditional finance, if the market crashes, human regulators can literally halt trading. They can step in, call the banks, and institute a circuit breaker to stop the bleeding.
They pull the plug.
Exactly. But blockchain smart contracts do not sleep, and they certainly do not care about human market panic. The IMF warns that because everything is governed by code, you could see automated margin calls triggering liquidations.
Which then lowers the asset price.
Exactly, which triggers even more automated margin calls. You get these continuous, unstoppable settlement loops accelerating a financial crisis in milliseconds, far faster than any human regulator could ever intervene.
So traditional finance inherits the massive efficiencies of the blockchain, but they also inherit the terrifying, unstoppable speed of automated financial physics.
That is the trade-off.
Which brings us to the most fascinating evolution in this whole ecosystem. Because institutions are not just using these fast tracks to trade traditional assets like stocks or currency anymore.
No, they are expanding.
They are literally turning uncertainty itself into a tradable commodity through prediction markets. We are seeing platforms like Kalshi go completely mainstream. Fox Corporation is now integrating Kalshi prediction market data directly across its primetime news and weather broadcasts.
And the crazy statistic here is that 70% of the people visiting Kalshi do not even place a trade.
Wait, really? 70%?
Yes, they just view the forecasts. That statistic is vital because it proves prediction markets are acting as a real-time information layer for the public. They are becoming a decentralized source of truth.
That is wild.
But the institutional side is even more compelling. There is a major working paper circulating right now that mathematically proves prediction markets are structurally superior to traditional derivatives for institutional risk transfer. The researchers quantify something called the Vega wedge.
Okay, hold on. Vega wedge. Variance risk premiums. Bank balance sheet costs. We need to translate that into plain English, mate, because that sounds exactly like the kind of jargon designed to make financial advisors look smart.
Fair enough. Let's break it down. Say a massive shipping company wants to protect itself against the risk of the Suez Canal being blocked.
Okay.
In the traditional financial system, they have to buy a complex options contract from a major bank. Constructing that contract is like building a custom house. The bank has to calculate complex mathematical variance, they have to charge a premium just for tying up capital on their own balance sheet, and there are layers of legal fees.
So it was just incredibly expensive.
Exactly. That massive extra cost, the friction of traditional banking, is the Vega wedge. But in a prediction market, you do not need the bank at all. You simply buy a binary contract that says, yes, the canal will be blocked, or no, it won't.
It just cuts out the middleman entirely.
It prices the binary risk in a single contract at a single price without all the friction of multi-leg derivative positions. It is vastly cheaper and far more efficient.
I can totally see why institutions would love that efficiency.
Right.
But this is causing a massive regulatory turf war.
It absolutely is.
The Department of Justice and the Commodity Futures Trading Commission are arguing that sports event contracts on platforms like Kalshi are officially financial swaps, which means they fall under federal jurisdiction and preempt state gambling laws.
Right.
Meanwhile, states like Nevada are fighting back furiously, saying these contracts are completely indistinguishable from sports betting.
And I have to express some genuine skepticism here. Is calling a bet on a baseball game a financial swap just a clever legal loophole cooked up by lawyers to bypass state gambling regulations? It is a highly contentious issue, and looking at it impartially, both sides have very strong legal arguments based on their respective jurisdictions. But if we strip away the political fight, the core innovation happening here is something being called predfi, or prediction finance.
Predfi.
We have to separate the mechanism from the subject matter. In a traditional sports book or a casino, you are betting against the house, right?
Yeah, and the house mathematically always has an edge.
Exactly, an informational and statistical edge. But in predfi, the actual durable asset is not the bet itself. The asset is the legible forecasting skill of the trader.
Wait, explain that. The skill itself is the asset.
Yes. Prediction markets allow capital to form organically around individuals or algorithms that can accurately spot mispricing and manage risk.
Oh, I see.
If you are consistently right about supply chain disruptions, geopolitical events, or, yes, even sports outcomes, the market rewards your forecasting ability. That is why we are seeing countries like Brazil emerging as the absolute next major frontier for this entire industry.
Why Brazil specifically? That seems random.
It is actually a perfect storm of demographics and culture.
Okay.
Brazil has massive widespread cryptocurrency adoption, combined with a deep cultural familiarity with speculation, which is rooted in their historical lottery systems.
So the foundation is already there.
Exactly. They have the digital infrastructure and the public appetite, providing the perfect environment for prediction markets to move from a niche financial derivative into a mainstream, everyday asset class.
So bringing this all together, what does this actually mean for you as you navigate this space? Think about the pieces we just laid out. We have AI agents evolving into autonomous companies that operate on invisible, frictionless payment rails.
We have a legal system scrambling to figure out how to hold code accountable.
We have Wall Street pouring billions into ultra-fast blockchain infrastructure that could literally trigger automated market crashes. And we have prediction markets proving they're mathematically the best way to price risk and uncertainty.
It is a lot to process.
It is. So here's a wild thought to leave you with. If AI companies are going to operate without humans, how long until we see AI CEOs autonomously trading on prediction markets, completely removing humans from the loop, just to hedge the geopolitical risks of their own digital businesses?
It is entirely possible.
The entire global economy could just become machines, negotiating uncertainty with other machines. Thank you for joining us on Vocal Technologist, where we untangle the future so you do not have to. Keep questioning the technology around you because the rules of the game are being rewritten while we speak.
Spoken Tech for your ears.